Hi, I am Matt Bosnagel, and this is the Gray Report. I am joined today with Jay Reeder. Happy to have him, and we have a very great show. We're going to be talking about sentiment today, about investor sentiment, about consumer sentiment, and about maybe our own sentiment and expectation for the multifamily market this next year. We've got articles from John Burns Research and Consulting looking at investor sentiment specifically, saying that commercial real estate optimism is rising, namely apartments. RealPage, there's an article on the 2025 apartment industry predictions from our friend Carl Whitaker. There is a CoreLogic article on the 2024 housing market trends, and then finally a pair of consumer sentiment data points here. One from the Conference Board that says U.S. consumer confidence pulled back in December, and then one more recent from the University of Michigan Index of Consumer Sentiment showing a more compelling, I think, rise in consumer sentiment. So whether you're optimistic or pessimistic, there's something in here for you, and there's something in here for multifamily insiders or people that are just interested in the multifamily market. Welcome to the Gray Report. Let's get started. We're back together at last. Jay, thank you for coming in as Spencer is out of town, but he will be quickly returning. Actually, maybe even today. We might see him in the windows here in the background. The show must go on, and I'm happy to be able to talk to you again about the multifamily market and about how people are feeling at the top of the year. I think we've got some exciting things that we're working on that we can't share, which is always exciting. But then, I think that there's a lot of investors that want to hit the ground running in 2025. I know the whole slogan was survive till 2025, and I think that we're going to see a lot of evidence from a lot of different people that they're ready to buy. I don't know. How hungry have you been, and what do you think about the multifamily market at the top of 2025 versus the top of 2024?
Yeah. All right, Matt, thanks for having me on. How do I feel? I think that changes by the day. But looking forward to 2025, I enjoy doing what I do, so I'm going to be generally optimistic, but I'll have days where reality kind of sets in. I think that was a lot of what we saw. 2024 was tough, but I think we found some opportunities in 2024 that made us feel better than maybe some others did. Yeah. 2023 was a rough year. Mm-hmm. 2023 was the year that was really, really tough. And so I think where we see 2025 is I think that there's going to be opportunities for good properties. But I know, as I've told you here recently, I think what that's going to be is people are going to be looking for quality. Yeah. As you said, survive to 2025. There are a lot of loan maturities. We've talked about it on loan maturities reports. Mm-hmm. We thought maybe that was going to hit in previous years. Yeah. Stuff got extended. It ended up not. And I think that 2025, I think it's going to end, but it may not end bad for everyone. As we've seen, rents are continuing to rise. Properties are doing better. Interest rates have started to come down. They've since gone back up. Mm-hmm. But as that kind of creates some sort of equilibrium, I think that a number of properties maybe won't be great opportunities for people, but I don't think people are going to be hurting on as many as maybe we initially thought. Yeah.
Well, then let's just go to this first article that we have here. It is an article from the John Burns Research and Consulting outfit, and they have a fear and greed survey, and I like it because it's directly applicable to commercial real estate. It's not exactly like a consumer sentiment. It's investor sentiment. And the headline here, which I've repeated at the top of the show, was commercial real estate optimism is rising, namely apartments. Some of their key takeaways is a growing net share of CRE investors, increasing exposure to CRE. Some expect distressed opportunities because 31% of investors who have CRE debt will be seeking out new debt at much higher rates. And then finally, the CRE investors are planning to dip into cash reserves, seek outside capital injections, or sell or dispose assets to cover their increased debt obligations. I'm going to skip to this because I think that this is the interesting part in this. Yes, people, the upshot to the whole thing is like optimism, especially compared to their previous reports. They actually have, this is a relatively recent survey, but ever since they began, it's been tracking upward. They started maybe in the doldrums, and then now they really are tracking a compelling trend of more optimism among CRE investors. Now, let's get to the loan maturity report. The loan maturity section of this report. How do you plan to handle your firm's commercial real estate loans that mature in 2025? Number one is I plan to obtain new debt at market interest rates. And number two, I don't know. I think that is a more convincing answer that would mean maybe distress, because you don't want to acknowledge or know. Well, I'll go into distress. That's what'll happen. Disaster. No one's going to really probably answer that as their answer. But that uncertainty is a signal, I think, for maybe some spotty distress. And that's what I wrote here in my notes when I was preparing this. Is I think there's a difference between a wave and a wall. Maybe have a wave where it's a factor in the market instead of a dramatic wall where everyone is coming in at once and there's all these opportunities at once.
And I think you're hitting right on the head kind of with what I was thinking. And I think about this not just from loan maturities, what they're talking about here, but also remember that there were a number of people that took on longer term floating rate debt. So a 10-year Fannie or a 10-year Freddie, kind of in the 2021, 2022 range. Those aren't technically maturities, but a lot of those people are coming up on their 2 and 3 year interest rate caps, at which point the loan's not maturing, but they have to do something. They've been escrowing for a replacement cap, but that interest rate on that cap's probably going to be a lot higher than what they've been paying, so their cash flow is going to go way down. Or, hey, can I not even cover anymore? Or is my lender going to make me buy more? And so then I have to come to the table because the lenders will do analysis. I mean, we just got one on the one property that we have that has a floating rate debt, and they do analysis of what our operations are doing, and then what the replacement cap are. And we fortunately are doing well enough where we didn't have to escrow money anymore. Yeah. Just to kind of stay within our margins of errors that they want us to be in to be able to do a replacement cap. So that was a big help to that property. Is we have enough money escrowed based on how the property is performing. They put an analysis of what kind of replacement cap you need to get. Our replacement cap, with 6 months left before it expires, we have more than enough cash to buy a cap that allows our property to kind of stay performing well. And so we're fortunate enough to do that, but I know there are others that aren't that fortunate. And so what that may not be catching is these are expirations, not necessarily people that are coming up on those rate caps that are kind of interim milestones.
Yeah, that's interesting. So the other interest rate pressures than specific loan maturities, it reaches into the way that debt works in commercial real estate in a lot more ways than these discrete loan maturities. And the way you're talking, it almost seems like banks are getting a little more stricter or a little more willing to enforce some of the rules. And this could be
and
wrong.
I wouldn't say necessarily they're willing to enforce more rules, but they kind of have come to a wall where either they see, okay, this property is doing exactly what the owner said it was going to do, and it's performing well, and there's a business plan here, and we're going to continue to be business as usual. Or they've been extending, they've been doing and making special requests, and it's we just can't do it anymore. Yeah.
That, and it does seem like it's a limit. And part of my thought about the bank's different stance between now and 2023 is the economy is doing a little bit better now, and maybe it's less of a threat to the banks to have all these bad CRE debt. They can kind of afford to call out the bad loans. I don't know. Does that make sense at all?
I don't know that anyone can afford. I mean, if you call all the bad ones, it starts to get dicey. But I do think they're in a position where they can start to make decisions of what are the ones they're willing to cut their losses on. And I think one of the things that we've seen on the apartment side is maybe there's nothing they can do, and the bank's not willing to take a loss on the debt, but the owner's got to come to the table with some money. Yeah. And owners hate to do this, but in order to do that, you might have to sell one of your better propies to kind of continue funding these tougher properties. Yeah. Yeah. And that may be where some opportunities come in. But I mean, when you're looking kind of in the development space and where you're looking at stuff, right now, cash is at a premium. Whether it's trying to find investors, whether it's us, whether it's developers, all those people are kind of trying to be very, very judicious with their capital. They want to go after a good deal. They don't want to do every deal right now. Yeah. And so because of that, there are opportunities to kind of step in and say, hey, let's let's look at this pretty seriously. And I think that's kind of where we're going to see. Obviously, there's going to be the distress. We've all kind of known that there are those out there, but those aren't really deals that most people want to buy.
Yeah.
And the pricing that's going to come in on those, like, I'm just going to throw round numbers out there. So say someone bought this for $100,000 a door.
Okay.
Today, maybe it's worth, like, financial wise, maybe it's worth 80,000. Maybe it's still worth 100,000 a door. But odds are, if they were on floating rate debt, or if they didn't execute a business plan, or they didn't do some of the things they said they were going to, the property's probably in worse shape. They're probably running on a shoestring budget. So economically, you could say that, hey, your same NOI you bought it at, but the person coming in is going to have to put more money into the property. And so I can't pay the same price you did when I have to put more money into the property.
Yeah.
So then all of a sudden it's not $100,000. Maybe it's not even 80. Maybe it's $50,000.
Yeah.
And so I think that's where we're going to see some kind of friction in the market, is some of these things that need to be moved will need to be moved at a low price because of what needs to be done to them to move them forward. And that's not going to feel good for people that are on the other end of that. And it's going to say, okay, is it worth that loss on this side, or do I continue to keep this afloat and I sell one of my better properties?
Yeah. That makes a little more sense if it's a sellable property and then you're rescuing the property that, that you're underwater on, or that are more troubling, because I remember a few weeks ago, Spencer was on the kind of Marcus and Millichap 2005 Outlook, and him and another CRE professional were talking about these lesser buildings. Maybe they're distressed, and the big question is, who's going to find a buyer? And I'm thinking, well, yeah, who's going to find a buyer at a high price? You lower the price enough, and then you'll find a buyer. But what you're saying is, maybe it's not even worth getting the price lower there. You sell another property. You don't sell that horrible one, or the one that's like really nasty, because who would buy it?
And you can always, I think this is where it kind of goes, is who is the seller as well.
Yeah.
There are some people out there who are not big enough. They cannot afford to take the reputational hit of that kind of loss on their balance sheet. There are other groups out there who it's like, I have this vast portfolio. A default on one loan is not going to crush me performance-wise for future investing. So it's like, okay, I'll take the loss on that. But if someone can't afford to take that loss, and they have a good property, they're the old saying, put good money after bad. Like, they may have to put good money after bad, because otherwise, if they just walk away from the bad, they may not have a lot of options moving forward.
No, that makes sense. It's like it's not a failure yet until it's kind of realized, and you maybe we'll sell. And it also kind of echoes my thought that that higher interest rates, the pressure of higher interest rates, is going to be continued to be felt in the market, and it's not going to be a lot of dramatic, moments. And it may not be, these distressed fire sales that are happening. It could just be a lower, just more sales activity as a result of these interest rate pressures, people wanting to sell a nice property to help a bad one, or for whatever reason. So just to kind of follow up on that a little bit. So the question was, how do you plan to handle your firm's commercial real estate loans that mature, new debt? That was the first answer, and then it was I don't know, and et cetera. And then the next question that was related to the similar topic was, how or when you take out new commercial real estate debt at market rates, how will you handle your increased debt obligations? And there, the top answer was, again, undecided. I don't know. It was a number 2 answer for before. It was a number 1 answer now, and that to me highlights the uncertainty in the market in the area of interest rates is a big question mark for me. I don't know how people are going to.
And the interesting part of that, and it could easily fall under something else, but notice none of the answers there are, I'm going to continue to operate my property as usual.
Yeah, that's a really good point. Yeah, something's got to give at this point. And I also think, so it's been, we've had a year and a half, 2 years of living under high interest rates, or even just looking forward to high interest rates, right? Right when they started the rate hike cycle, everyone kind of knew where it was going. There wasn't anyone that was really that deluded that thought it's just a passing shower. It was a flood, and the interest rates rose, and I think people's mind. It took a lot of time, I think, for people's minds to shift. And this quietude in the CRE market, I think, means that it's not going to just jump back to normal, 2021 era. But who's to say? I think there's a lot of uncertainty that may pervade, and maybe there's opportunities there. But it also ends. So again, the tone in this John Burns Research and Consulting article was positive, and I think interest rates represent some uncertainty, and they also highlight policy risk as a major unknown variable for 2025, namely tariffs. A couple lines here, a couple paragraphs. I do think that is, that's going to be an economic uncertainty. I don't know what's going to happen. That's a big question mark for me. It's a little bit more of an unknown than like the finite unknowns of like interest rates and what might happen there. I think interest rates are a little bit more. I'm thinking about that more than tariffs. Although if you talk about the larger economy, maybe tariffs is.
And it's interesting with the tariffs though. When we do investment committee here, we obviously talk about, okay, what are the pros and cons of a deal that we look at, and one of the things that we look at is, okay, what is the economic driver of where we are, and obviously being in the Midwest, there's a lot of manufacturing. Yeah, and it's kind of this double-edged sword. I remember the last deal that we put through investment committee, we sat and talked about it. It's like, okay, if these tariffs go, it's one of those things where it could either be really good or really bad. If these tariffs go up, maybe they have these manufacturing jobs for whether the automakers or the logistics and all of that we kind of have here in the Midwest. Are they going to kind of keep some stuff stateside and increase jobs in those areas? Or are they going to try and find some other route where maybe it pulls away from the manufacturing in that area? Yeah. And it's just kind of one of those things that
maybe there's a tariff on a part that that has to be imported for the manufacturer, and so instead it's like increases their costs.
Instead of importing the parts, maybe it's cheaper to assemble the whole car somewhere else and ship it here, as opposed to assembling it here so it's American made, but then all the parts are pulled in from other places, and it's kind of all those factors. And so I know the last deal I'm specifically looking at, I remember Andrew talking about it and saying, hey, if we have these tariffs, these are the higher industries in the area. Yeah. And so we just need to be cognizant of that. Mm-hmm.
Yeah. And I don't know. It would be difficult for me to imagine some truly economically disruptive policies getting put in place immediately. I think there's probably going to be a lag time, and we'll see it coming, and hopefully that will leave room for some discussion about the issue and some nuance, but who knows? There is I think this is what the people voted for. So, maybe it'll turn out okay. I don't know. Well, let's look, speaking of optimism about the future, or uncertainty. The Conference Board a couple weeks ago, it was about a week ago, they released their data for December, and they're saying that consumer confidence pulled back in December. Concerns about the future returned. They the quote here is, the recent rebound in consumer confidence was not sustained in December as the index dropped back to the middle range that has prevailed over the past 2 years. While weaker consumer assessments of the present situation contributed to decline, the expectations component saw the sharpest drop. So people's expectations were a little bit lower. Their assessment of current conditions was fairly okay. But I also I'm going to pull up the chart here to show the volatility of this measure. Overall consumer confidence down 8.1 points. Now it's 104, and I guess maybe 80 is the magic number where it's a recession indicator. I'm not really sure there. The present situation went down 1.2 points. The expectations confidence was down 12.6 points. And so all of these are roughly out of 100. Maybe it's a little over 100, a little under 100. But essentially these confidence measures are dropping by 8 or 12. But the present situation is still okay. It's only dropped by about 1%. Looking at the chart again, for the past 15 years, you really see the volatility that can happen month to month. You see a general progression of increasing optimism from 2009 all the way up to 2020. That was, interestingly enough, the heady days of stimulus checks in like 2021 and low zero interest rates. That wasn't peak confidence. Peak confidence was in like 2018 and in the couple of years before the pandemic. So right now we are hovering around where it was about 2016, like in the middle of 2016. We're a little bit above that, but that's about as confident as people are. And yeah, it's just shaky month to month. So I'm not really, it doesn't, yeah.
I find it interesting on looking at this chart, and I'm trying to date some kind of milestones in my head based on those days and what consumer confidence would be. And it's interesting that everything was so bad in 08, 09. And I remember applying for jobs in that period of time.
Yep.
And it was like you couldn't find a job. Mm-hmm. And I think that definitely contributed to kind of the confidence, because no one, like, you just couldn't get a job. I almost feel like I've heard more about inflation. I've heard more about everyone's craze about the economy now maybe than I did in the years after, like 08 and 09. Obviously, 08 and 09, it was everywhere. But then kind of in those years afterwards, people felt it, but it wasn't in the news every day. It wasn't in the news every day. But yet, based on your baseline there, we feel better about it today than we did in those years afterwards.
Yeah. It's super interesting how much inflation has been a product, or has had an effect on people's sense of the economy. I think this shows it's just hard to disentangle it with what people think of. They're not balancing wage growth and inflation. People aren't really thinking about that. And they're not thinking about, well, the rate of inflation's down. They're looking for price drops. They're not looking for inflation drops. They're looking for the prices to go down. And like that disappointment, that's hard to quash.
It's even here where we are, like, obviously during COVID in 2020, 2021, everyone was concerned about everything, whether it be supply chains, can I get enough food? And so I guess I'm actually surprised it stayed as high as the consumer confidence index is there, because I do feel like we are more confident now than we were then. I would tend to agree with that, but I do feel like that was artificially high, because I don't feel like many people had a lot of confidence back then.
Yeah, that's a good point. Now there are other parts of this report here that I do want to call out. Some more charts and some more. The ways they slice and dice this, it's not just confidence or not confidence. For instance, this present situation index shows how everyone's feelings of the present situation are doing okay, but their expectations confidence, that how do they think things are going to be 6 months hence, is down. We are about at the 80% mark, which is, according to them, like a threshold for maybe it'll be a recession. Now, as the viewers of the YouTube series, I apologize to the podcast. I will I'll describe this vocally here. There's a lot of times where the line where the expectations crosses this 80% recession indicator, and a recession didn't happen. I think that expectations almost, and we were talking about this shortly before the show, it's almost like people were trained to have bad expectations during the Great Recession. They weren't thinking that, they weren't pulling their hair out like people have been about inflation, but it was a period of extended low expectations, and we got a little bit above it in 2018, like we said earlier, but it was easily dipped back down to, and people remembered, and there was a muscle memory of, oh yeah, this economy, oh man, what can you do? And so that's what I think is partly, it's like this kind of collective training.
I wonder if the expected index, present situation, you're going to go to the store, you're going to see how you feel, and buying stuff or the availability of things. Looking forward, you're going to be at the influence of kind of whatever you're hearing out in the ether, wherever you take your information of.
Yeah.
And this is, I'm not trying to go here, but
I am. Let's go.
This is where you talk about, like, where do you get your sense of information? Do you get it from media? Do you get it from social media?
Yeah.
Odds are the old adage of, like, what sells, like disaster, anything that's depressing, like all of that is what sells. So if that's all you see, that's all you're going to think the future is. So I can see why that.
All the thumbnails, the YouTube thumbnails with flames behind them, or like nuclear bomb explosions, and saying like economy crashing. Those get the clicks. You're right. Yeah.
And so if that's what you see, and that's what algorithms are portrayed for people to see, you're always going to think the future is worse.
Yeah.
And that's why in that graph, the future is never really above what people actually think today is going to be. Everyone's waiting for that shoe to drop.
Yeah. No, very true. And just to scroll down, which is super interesting, I think I may have noted this, the family's assessment of their current finances is largely good. And their expectation, again, their expected financial situation 6 months hence is better than it's more better than worse. So their expectations are higher on their own personal and their family's situation. But if they look, in the larger economy, they think it's going to go bad. So I think that is a little bit telling there. It's like, someone, oh yeah, I'm doing great, but the economy, oh geez, no, I'm doing pretty good, but oh yeah, the economy, I can't believe it. It's because I think that has been the narrative, and I know that seems a little bit touchy-feely, but we're talking sentiments here, and I think that has been a push, especially this year. It's an election year. What is going to get more people to donate to your chosen candidate than saying like, oh man, it's going to be a disaster unless we step in. So I think that's a big thing. But overall, the perceived likelihood of a U.S. recession over the next 12 months, that is going down. And I don't think that the reduction in consumer confidence, we can kind of scroll up, is that alarming, considering, it's at an absolute level, it's still relatively high. Now let's move on, and just as a counter, as a counter to the Conference Board consumer confidence, is University of Michigan recently released their index of consumer sentiment data for December, and you can see looking at these numbers a clear progression. So I'm going to compare here. You get a jagged, bumpy line when it comes to consumer confidence, hovering basically around the same level. But if you look at the University of Michigan numbers over that same period, it's not a bump. It's not jumping at the same level. It is kind of a stair-stepping in a positive direction, and I think that seems to me to hold a little more water. It's a more compelling trend in this University of Michigan numbers that are showing gradual positive feelings about the economy when comparing it to the Conference Board. But I don't know. What do you think? Does this hold water or?
I do feel, I think I mentioned this when we looked at this chart earlier.
Mm-hmm.
I find it interesting that the bottom of this was 2022, where I would have expected the bottom to be is 2023.
Yeah.
Maybe it's lagging indicator. I don't know exactly know. I know in 2022, interest rates were going up, but I don't think people really thought it was that bad because it took most of 2022 for interest rates to go up, for that inflation to really be like, oh wow, this is really hitting me. And then 2023 is where I feel like everyone was like, this hit me hard.
Yeah.
And so I guess I feel like in my mind, I'm a little surprised it's up since mid 2022, but I don't think I'm surprised that it's up now compared to 2023.
Yeah, and I think what makes me like this chart 2 from University of Michigan is they show a more clear drop off from kind of pre-pandemic to post-pandemic. It seems a little bit more dramatic. You get that bump down and then it goes down. But in mid 2021, you had a spike that was almost the peak of consumer confidence in the Conference Board. But then you look at that same period, mid 2021, in the University of Michigan numbers, and it does not reach close to that peak. It does peak, follows the same pattern, which is, I think, helps me to think that might be accurate, but it just doesn't come up as much. So I'd like to think that's a little more valid. Who knows? I think combining these two, though, considering they all are following the same patterns and they're following similar trajectories, notwithstanding some volatility on a Conference Board, if you're viewing both of these, I think that it shows a story of people are getting used to this economy. People are getting a little more confident. Things are getting a little more predictable. And
I would say you probably hit it right there. It's more predictable. I don't think anyone feels confident. Anyone feels good about it.
Yeah.
But it's living with it, and we've now lived with it this long. It's not going to hurt us to keep living in it. I think is the sentiment I have gotten from people.
Yeah. No, that makes sense. All right. So let's move into the multifamily market specifically, and then we'll move into housing after that. But about so Carl Whitaker has a short, brief, but I think thought-provoking piece on 2025 apartment industry predictions. Now, yeah, we've seen what the common riffraff that are answering the conference board surveys, what they think and their expectations. I put my money behind Carl Whitaker any day, and here of his few quick predictions for 2025, and I'll go over them even quicker, and then we can discuss them a little bit more at length. He signals supply as the key theme for 2025. He also says that renters in high supply markets will see concessions as supply remains a heavy force, and then demand will continue to catch up with this wave of new supply throughout the Sun Belt, where rental growth is likely to be modest. Meanwhile, based on supply-demand factors, rents in lower supply metros are expected to grow at a pace similar to 2010's decade. Now, I read that whole paragraph because I think that's where the juicy part is. I am, at least my expectations for the 2025 multifamily market is a continued exacerbation of regional or market-specific differences. Some of the places that have had a lot of newly built apartments, they're getting even more maybe in 2025, and they still have, that market hasn't balanced out for them yet. And I wonder if, even apart from this, so maybe if construction stopped in 2024, that market would still be working on absorbing all the new ones that they got this year. So if they're getting even more, they have more time to absorb and more, that's just going to hit. It's really great. I think, we talked about this with Spencer last week. It's really great to be a renter right now in Austin, in that you probably are paying a little bit less rent because there's so many new apartments coming up. Same thing for Phoenix. Same thing for places like Tampa. They built a lot more apartments. Rents went down. Other places, they didn't build as many apartments, and the demand is catching up a little more quickly.
And I think that's where you really see it is, we've had markets that we look at, like we're invested in Bloomington. Bloomington has seen some nice development lately, and so we see it a little bit smaller scale. And I think it's always kind of come back to the like the steady Eddie and all that, because where we look on a regular basis, yes, there's development here in Indianapolis, there's development in Lafayette, there's development in Bloomington, there's development in Fort Wayne.
Yeah,
but it's not 50 complexes going up like you're seeing in Nashville, in Phoenix, in Austin. Like they were just at such mass scale how much was going up that
at every little submarket you can't really find one that doesn't have a new one.
That doesn't have it. And so we saw some growth. Obviously, when rates went down, people were like, oh, I can pencil some stuff. That kind of happened across the country. But as you said, there with supply, and I think we're going to go more renters here than it goes on kind of the buying and selling apartments, but I think it is correlated. The biggest thing is right now with interest rates where it is, the ability to develop new product is almost non-existent right now.
Yeah,
I'm not saying it's zero. There is a little bit. There are some people that are very convicted, and I've got a lot of admiration for the people. I know some of those developers, and I like what they're doing. But as a whole, it's really hard to get into that right now.
Yeah.
And so right now you're seeing the glut of what was developed in 2022, 2023, 2024 coming to market. And as that comes to market, rents are going to be lower for renters. And I think you're going to see that about everywhere. Even Indianapolis, where we are, rents have gone up, and it's not like we're seeing rent declines, but we're staying pretty steady. We're not seeing huge bumps. We're seeing 3%. In some submarkets where it's a little bit nicer to get into, we're seeing maybe the 3 to 4 as opposed to the 2 to 3. But it's pretty even. But places like Austin, Phoenix, Nashville, where you had this huge craze because people were paying these crazy amounts for rent, and be like, oh, I can underwrite to that. Well, it's there, and now all these people can look around and be like, okay, moving sucks. I don't really want to pay for a mover, but they're going to increase my rent. Or I can go to that new one across the street that's just trying to get people in the door, and I can get 2 months free and pay $100 less a month. And a 2-year-old newer property.
Yeah. So I have a question, and I was thinking about this. It was like a Reddit post or somewhere. They were like, how do I go up to my landlord and say, I want to stay, you're charging me more, but I could go across the street to this new apartment and get it cheaper. Like, how do those discussions happen? Because I think that they could. I just don't know what
could happen. The one thing, because we have to do it when we send out renewal letters to our residents, that we have to say is like, what is the cost of moving?
Yeah, and what's the cost to you for as a landlord?
Well, not even a landlord, like, because we know what the cost is for us. It's just normal terms. We budget for that. It's all that. But it's like, okay, yeah, you're gonna save $100 a month. Well, do you have a friend here that you like to hang out with, that you guys go down to the pool and hang out with?
I don't care. I'll save $100. We can go to another pool.
But we'll get there.
Yeah.
So like, okay. So you're all of a sudden it's like, okay, well, if you want to hang out with that friend, now you're driving somewhere.
Yeah. Yeah.
So now that's gas to go between the two. Oh, you want to move? Okay, you gotta move now. So you gotta probably rent some sort of box truck.
Oh, I don't want to move. You're right.
And so, okay, there's $200 to go get that. And I mean, you could really splurge and have movers and be close to $1,000. Well, all of a sudden that $1,000 is your $100 difference over the course of the year.
Yeah. Yeah.
And then you have your deposits that you've got to put down if you switch utilities. Like there are costs associated with moving. And so I think as landlords, one of the things we try to highlight with our residents, maybe not people that are moving into houses, but are like, oh, I'm trying to chase and go to get a better rate at the property next door. It's like, but are you saving money? Like maybe you'll save $100 a month, but you're going to have to shell out $1,100 to move. You're going to have to put down a new deposit because we won't have returned your deposit yet. Like, and maybe you don't get your deposit back from us. Like there are kind of all of those things that factor into it. Where is it really cheaper? Now, in some of those markets, it very well could be.
Yeah.
But in maybe your markets that aren't as big peaks and valleys, it probably on the surface looks like it's a better deal. Yeah. But it may not be.
Okay. No, that really makes sense. I wonder for some of them if that's the reason why I'm seeing some of these articles about retention increasing, where I think it was a Redfin article or maybe it was Realtor.com, where they're saying that I think it was by 30%. Some of the retention that they're seeing, people stay for 2, 3, 4 years instead of I didn't know this, and maybe I'm wrong here. As a rule of thumb, how many renters leave the apartment building every year? I've been saying, in cocktail parties, 50%. And I always thought my own conception is like, no, and that's way too many. Half the renters move out every year. That's so crazy to me, because I think like, well, if I was in an apartment, I'd stay for 3, 4 years, but that means essentially like you're there for 2 years and then you're gone. And that's crazy.
I would say average is about 50. I would say high turnover would be about 60. And then like even your best ones where it's like, oh, I'm super low turnover, even that's 40% turnover.
Wow. So, and again, like because of the way that, stabilized apartments are thought of as like, oh no, it's good, it's stabilized, at least we don't have to fill it up. But like, no, you got to fill up half of it pretty much every year.
Fill half of it every year. But I always talk about it this way. And like, whenever I'm sitting in an asset management meeting with our people, I'm like, okay, our occupancy goal is, call it 93 to 95%. And say we're sitting at 92%. It's like, okay, well, how many move outs do we have coming up? It's like not how many lease expirations, but how many move outs do we have? Okay. Well, how many leases do we average getting a month or a week? And really breaking it down of like how many is that per week? Because our largest property is 444 units.
Yeah.
And so if you take that 444 units, most of the leases there are concentrated kind of between March and call it September.
Okay.
But we have some sporadic kind of throughout the winter. The previous owner on that one basically only leased March through September. And so we've kind of spent some time spreading out those leases a little bit. But if you take that 444 units and you divide it by, call it 12 months, obviously knowing that winter is going to be a little bit lower, summer is going to be a little bit higher. But if we're just going over that, you're looking at, my math is giving me now, I think, 36 roughly. Let me do my math here.
We got it.
So 444 divided by 12, 37. I was close.
Yeah.
So, okay, if that 37, well, now you're looking at, okay, how many
a day?
Weeks? Well, how many weeks are you doing in a month? Call it 4.
Yeah.
So you're taking that 37 divided by 4. So I need 8 leases a week.
Man.
And it's like, okay, what does it take to get 8 leases a week? Well, that's if I have to lease up the entire property.
Yeah.
Now cut that in half. It's at 50%. Right. Well, now it's not 8 leases a week. It's 4 leases a week. That's less than 1 lease a day.
Yeah.
So if you're a leasing person, like if I went to like a high end like Prada store or something like that, because that's one of the things I always try to talk about. I think I've talked about it on here. Like we are are leasing a luxury item.
Oh, yeah.
You may not think about it that way because it's like, oh, it's my apartment. But I mean, when you
$1,000
sign
or $2,000 every month.
When you sign that contract, you're not signing a contract for $1,000. You're signing a contract for $12,000.
Yeah.
Now you're going to pay it in increments, but yeah, you're signing a $12,000. So think if you went to like the Coach store or like Louis Vuitton store or something like that. If you told them that all they had to do was sell one purse a day.
Yeah. No, that's a good point. And but it also, it also emphasizes how much, like, I am amazed at how people still come in the door. There are still people there that will stream in and will look for it and will look for a place to live. But to have that unknown and have that big question mark, that I would be very jittery if I was a new leasing agent and thinking like, well, are we going to get that single customer today? Because things are really expensive.
If people are reaching out to you, they need a place to live. So you have a captive audience. Like if they're reaching out to you, they need a place to live.
Yeah.
Now, is what you offer what they need? Probably not. Well, maybe not. Well, that's up to them because you don't know like how close are you to work? What do they need? I mean, we have properties that only have 1 and 2 bedrooms. Well, there may be someone that needs a 3-bedroom. And so if they're calling you, maybe you don't fit what they need. But if someone is calling you, they need an apartment.
Yeah.
And so
No, that's a good point, and it calls to mind someone. It was an old podcast I was listening to about car salesmen. It's like, well, you came into the door. I know you want this car, or I know you're looking for a car. You're pretty serious if you're taking that step yourself. So no, that's a good point. It always surprises me. Because as an individual, the decision that I'm making on whether to buy a home or whether to rent a home, all of those times, those movements that I've made throughout my life are relatively rare. But leasing agents and people in the multifamily industry, they're dealing with these hundreds at a time. And so it always surprises me to think that, wow, at any given time, people are in such volumes are looking for new apartments or they're moving out of their apartments. And it's just, I'll have to pat Katrina on the back again, because to be able to deal with that and to treat it with like what you said, it's a luxury item. It's a serious decision that people make. And it's the same. It's kind of similar a little bit, kind of like to a realtor. Like you've got to guide someone through this, and it's a responsibility to help people through this decision from your position of experience. And so, there's lots of good I think that leasing agents can do. But I think sometimes maybe it is worth moving if it's a little too high. But let's move into housing in general. The housing market in general, there's a lot of demand, and I don't necessarily know about the connection between house price increase and apartment prices, but I do think that is a signal of rising demand, as you can see here.
I agree with you, but the one kind of albatross that's out there when it comes to the price of housing versus the price of renting is the down payment you need for the house.
Yeah, very true.
Because in apartments, it used to be like, I remember like way back when, like I ended up living in the fraternity house in college, but I know like as friends were looking for apartments, it was like you need a month, maybe even 2 months of rent. And so there was kind of this like barrier when you got an apartment.
Yeah.
And I think my first apartment was like, I think it was a month, but I mean, my rent was $500. And so it wasn't this huge kind of like barrier. Housing, like, mortgages are getting more expensive. Is it relative to apartments? But do you have that down payment?
Yeah.
And I think that's one of the things, as we've seen with the confidence in the economic markets, I don't know that people feel confident enough to put down that down payment right now, unless they have a house or they have come in some sort of capital event, because things got so much expensive. It is hard to set aside money. Yeah.
I wonder how this would correlate with like the savings rate of people. If you see more home buyers, or if low interest rates and higher savings rates align, that's a really good point. And that's something I remember talking about way back when the Gray Report started, when interest rates were really low. We were still talking about high home prices, but we were really fixated on that down payment as a real barrier to home ownership. And, there are different ways you can live in a home, you can rent a home, you don't necessarily have to own a home. But that's everyone says it's like that's the American dream. We are a nation of homeowners, whether we like it or not. And I think we probably will see a greater shift slightly to renters, but I don't think it's going to be like a sea change by any means.
I think that one thing, and again, I think I've mentioned this one of the last times, not one of the last times, but one of the times I've been on the podcast with you, is one of the things I always kind of keep an eye out for is the wave of boomers.
Yeah.
At a certain point, we know that the generations after the boomers are less and less than what the boomer population was.
Yeah.
That generation owns homes. 100% that generation owns homes. So when that generation, whether they pass away, whether they downsize and move into an apartment community, as that generation downsizes and those homes become available, they pass away, pass them to their kids. And if all of a sudden it goes to your kids, then maybe I don't need that down payment. I just need to assume the loan and I need to make the payments. Well, if that payment's the same as, or even a refinance and that payment's the same as what, like I was renting an apartment, then all of a sudden you can see that transition into home ownership. And what is that wave going to do to the apartment? Are people just be like, I don't want to deal with a house anymore? Because all of a sudden the supply of housing is going to be there. So when you're talking about supply and demand, that supply is going to happen again. But is like the consumer idea of like, I just want to rent. I don't want to own a house. Are people going to make that switch because the houses are available, or because they've gotten so used to renting? Are they going to continue to do that?
Yeah, I don't think. I think that people would gladly live in a house that they own more than when they rent. I think there's an idea of control inherent to that ownership. But I also, it's like. It's like you go to, you see in college, you're renting your apartment, and then you go to the fraternity and they're able to build these crazy pools and stuff. And it's like, I don't know, if I wasn't a landlord, I would not let people do that. And but my point is like, is there a happy medium where a landlord or a renter of like single family home can grant a little more leeway to for someone to maybe like repaint or do something to improvements toward the home, except like that's costing you as a renter. You're going to move out and that's going to still stay the same. So it's harder to see. It's harder to build this like kind of sweat equity, like I'm mowing my own lawn or I'm doing the repairs of my own. It's like I kind of feel good about that and I'm motivated to do that. Versus if you're a renter, no, that's the landlord's job. I'm not gonna fix this thing that's a landlord, or spend an ounce of my time or money to fix what a landlord should fix. But
because
at the same
I've already
time,
spent my money to do that.
Yeah, because you already spent your money to do that. But I think robbing someone of the like there's like an identity and a connection to the home in those little minor things, but that's touchy-feely sentimental stuff. So but
that's making an emotional decision.
Yeah, exactly.
That's not
You're
making
right.
maybe a money-based decision.
Yeah. So just to close out this housing market trends, the upshot to this is that while growth cooled in 2024, it did not shrink. This is a little bit of a deceptive graph. It is and instead of ending at 0, it ends at 3.4%. So essentially, at the last time they measured it, year-over-year growth in the housing market, this is October, was 3.4%. You could see probably further declines. I don't think that it will get to all the way to 0 in December, although this is a notable trend in the housing market is shrinking price growth. Price growth has not been going like gangbusters. I've been talking for so long. It seems like this is so bizarre to me that home price growth would go down in this way, because home prices have been so resilient to interest rates. They took a little bit of a dip, but they've still been plugging away, like really, really healthy amount of home price growth. And it's nice from us from multifamily perspective, because that indicates housing demand. However, if this trend continues, we may see further, perhaps a small amount of home price declines. I think that remains to be seen. Maybe as like the home buying, I don't know what the difference between home buying and apartment rental patterns are, but maybe we could see similar patterns there. Like if there is a chief home buying like season, like the spring, maybe home price growth will go up. But the other upshot to this is this subheading that I wanted to signal again is it's kind of my theme for 2025 too, is a nation divided by price growth. And I will argue that this nation divided by price growth in the single family area is similarly divided in when it comes to multifamily rent growth. They're looking at year over year price changes, and there are a lot of these hot markets that had some big price changes, like home prices in 2023 went up 8.8% in Miami, and then in 2024 they went up 6.2% this is the same city, Miami. So big price growth. However, if you go to the 4 states that were home to the most at-risk markets, these places are Atlanta, Daytona Beach, Tampa, West Palm Beach, and then Palm Bay, Melbourne, Titusville, Florida. These are all it's Florida, Georgia. These are Sunbelt markets. I wonder if there's a little bit of a kind of a snapback in home values when it comes to the Sunbelt in single family homes as well as apartments. I don't know though. I'm too out of I don't know the construction trends in single family versus apartments. I like to think that there's a little bit of a parallel there.
I like to think there's a little bit of parallel, and one of the things I know we're coming up on our time here, but one of the things that I think about especially when it comes to real estate is what's the cost to build the real estate.
Yeah.
And there's inherent cost of that, and it's like, okay, when houses are buying and selling, you can find stuff that you buy below what replacement cost is, whether it's a single family home or whether it's apartments, kind of what we do. That is a metric that people look at.
Yeah.
But if you think about it, that kind of goes away as something gets older.
Yeah.
And the people who made that initial investment no longer care, and it's just like, okay, what do I need to get away from this? And I feel like in the real estate world, there's this this kind of mental block. People would think none of it if they went and invested in a stock. And I think a lot of it has to do with the amount of money that it takes to do this. But if someone invests in a stock, if it goes down and you're like, you know what, I'm not feeling comfortable with this. People don't think twice about selling a stock at a loss.
Yeah.
People have a huge aversion to selling real estate at a loss. And so that is kind of where I see with these price growths is, especially in places that have had a lot of new development, people are going to hold out for that price because they're not going to lose money. But places that are older and have season in their housing stock isn't growing, that resident reticence to sell isn't there because there's not this perceived notion of what that is worth.
Yeah. That's super interesting. And it kind of jives with some of the discussions that I remember having a year or two ago. People were mentioning about mature markets. And I think this was actually an older Berkadia piece about volatility. And this was a Noah Stone and John Rappa back when they were at Berkadia, which was the golden years of Berkadia research, by the way. I think about the that Berkadia piece, and it talked about volatility, and it talked about some of these less mature markets, maybe younger cities. I wonder if it's less about how mature a city is and how quickly things can get absorbed, or just the regular volatility of having a surge of apartments in a specific city.
And it's not even necessarily a surge of apartments. I think it's just a surge of all housing in general. Because obviously it correlates and people are going to flock to, and apartments may be easier because scale, you can get a couple acres and put whatever you need to versus maybe a home subdivision where you need significantly more because in order to kind of get economies of scale and the types of housing, you have to have a little bit more land in maybe a desirable area. But any of those markets that have kind of a housing boom are going to see those same things. Yeah.
It's interesting too. The U.S. states with the largest share of markets topping the charts for price decline risk in Q3 2024 is Utah, Florida, and Georgia. All 3 of these are, kind of hot housing markets, essentially. People wanted to move in the Salt Lake City area. People want to move in Florida, obviously. And the same as Georgia. There's that Sunbelt narrative. And then there's also that narrative of Utah living near the 80,000-year-old quaking aspen tree or whatever. But maybe things are shifting. I think it's more of a story of a lot of housing was built there and a lot of attention was paid there, and there's a little bit of a snapback now. Now, Florida, there may be a hurricane hurricane insurance related thing.
And I think the one thing that like it kind of goes along with this is just because it's had a lot of growth and it's new doesn't mean it's bad. Yeah. If there's housing or if there's jobs there to support the housing.
Yeah. It's a short-term, long-term thing. Like, all these places, they're going to be all right.
Yeah. Like when you're talking kind of like Utah, okay, Utah, yes, the people that live there are like, they have jobs and all that. But is there an industry there that can support a mass migration of people? Whereas like Austin, Texas.
That's a good point.
It has like Teslas moving there. It has these jobs that are moving there. When people moved out to Boise, when people moved out to Salt Lake, they moved out there because they wanted to be by the mountains. They wanted to be like that.
Yeah.
They had some remote jobs that they could do. They didn't necessarily move there because there's a job in Utah for me to go to.
Yeah.
And then if they all of a sudden changed jobs where they couldn't work remote anymore, maybe there's not the opportunity for them. And if people move and this housing stock was built up kind of on the idea of people wanting to move there and there's not the jobs there to kind of sustain it, I do think that some of the pullback that we've seen on the work from home is affecting that in some of these markets.
Yeah. No, that's a really good point. I think, well, and this is a more general question though. When you are looking at a market and you're analyzing it, is job growth really a really big deal? Like that's more than population growth. You're looking for job growth.
It's not more than population growth, but I think it's correlated. I mean, you can't go somewhere where population is increasing and jobs are decreasing.
Yeah.
At some point, there's going to be a cliff there. Now, is maybe like they're going up maybe one's a little quicker than the other, but they kind of go up together, typically in markets that we're looking at. But that is something that you look at because I'm sure those places like the smaller towns in Idaho or maybe Salt Lake itself is big enough, but kind of maybe some of the fringe areas south by Provo and all that, like that when people kind of move there because, I want to be outside, I want to be out of the mountains. Yeah, you had a remote job. If you could continue that remote job, maybe you stayed. But if you no longer could do that remote job, what are your prospects still continuing to live there?
Yeah.
And I think we've seen a little bit of that in the last couple of years as well.
There's stories of people moving back to like where they were from. And I think that some of it could be affordability. I think a lot of it is, remote work's ending and there's a pullback, a little bit of a return to the office. I wonder maybe a small portion of it is affordability. There's healthy job growth and healthy population growth in the Midwest. But I think a lot of this could be driven by remote work and just job growth in general. Like I said, so these Sunbelt places, they're the ones that are getting the most. They're actually probably leading in job growth and population growth for a lot of these Sunbelt markets. Yeah. It is just that the short-term housing supply issue means that, well, on the multifamily side, rents are going to probably not grow as fast, may even shrink this year, which is, I guess, good news if you're renting in Tampa or Phoenix or whatever. But long-term, obviously, things will normalize and balance out. It's just an indication of how powerful supply can be and how maybe with the waning effects of this huge supply wave, we might see a little bit of a supply shortage for apartments going into 2026 and 2027.
And I think you will.
Yeah.
And now how sustained, how long that is, who knows? And I think a lot of it has to do with where rent's going to get to, where a developer can afford to go in and develop to a projected amount of rent. That is the key there, because anyone could go put up a building somewhere and do that, but can the rents justify the cost to build it?
Yeah.
And that's, I think, really where you're going to see some of those shortages. And even those shortages, when supply starts to kind of come down and rents start going up, at that time, what are interest rates relative to what rents are to still be able to pencil that out?
Yeah.
Because if interest rates are still high, rents are going to have to go up a lot, and building costs are going to have to stay the same or not go up as much in order to be able to continue to make those pencil in for development to happen. Yeah.
Good point. Is there anything you want to add? Any other things that you're watching for in 2024 that maybe we weren't covering in our outlook or some of our discussions here?
I don't think
in 2025. I'm sorry. I'm still caught in the past.
I'm as well. I don't think there's anything I'm looking for, so to speak. I'm always kind of looking out for the metrics that are important to us here at Gray Capital. And I mean, I think we did a strong job in 2024. I think there are going to be some good opportunities in 2025. And I think one of the things that we've really looked at, as you've heard the last couple of times I've come on the show, is just understanding what the basis is, and coming in and buying real estate for the value of the real estate.
Yeah.
Not some sort of financial engineering, which is what happened in 2021, 2022,
Yeah.
and really getting it so that way our portfolio, maybe it's not a 25 IRR, maybe it's not a 20 IRR, but it is a solid deal in an irreplaceable location that people want to be in.
Yeah.
And really trying to do that. I mean, we did that last year when we went to Evansville. It was an older property, but it is right off of the main drag. It's where all of the retail is. It's right next to the hospital, one of the largest employers. So
Yeah.
the location was a premium there. We did it when we came back here to Indianapolis last year, and we bought Solana. We bought it right off of kind of the main drag on the north side there.
Yeah.
It's an irreplaceable location. It's right on the waterfront, high-end built units. And so there was this kind of draw to quality and draw to kind of the fundamentals of real estate of location.
Yeah. Yeah.
And that's, I think, what we're really focusing on, and what I'm looking forward is like the stuff that comes available for us to buy and sell. How much of it is worth us even buying? Like I said, people have kind of differing opinions on kind of the Class B, Class C stuff, but what's going to be that real driver for kind of the quality assets that come out in the next year or two?
Yeah, yeah. Well, great. Thank you. Thank you so much, Jay, for coming on. And for more information, you can feel free to subscribe to the Gray Capital newsletter at www.graycapitalllc.com/newsletter, or you can go to grayreport.com for quick updates on the multifamily market, housing, and the economy. Thank you so much for joining me again. Thank you, Jay. And we'll see you next week at the Gray Report. Thanks.
Thank you.